Welcome to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. We aim to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video. All opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers.
Well, this was it. This was the week we were waiting for. You're probably thinking, that's right, John Mark, a nice, long, beautiful holiday weekend where we nationally take a day to remember or memorialize those who have died in active military service. And you are correct. That's the way we as a nation typically cue in the summer. But for the markets, what we were waiting for, it was all about getting to what has now become the most important earnings report of every quarter, which is NVIDIA. NVIDIA is now the third largest company by market cap, only smaller than Apple at $3 trillion and Microsoft, the largest at a little over $3 trillion. And they are the face of the artificial intelligence craze that has driven the market to plus 20% returns in 2023 and so far double-digit returns in 2024, at least for the growth and the growth and income categories. For example, this year, some of the growth funds we monitor, the Fidelity Blue Chip Growth Fund, is up 21.26% year to date with NVIDIA as its largest holding. The Triple Qs are up 11.98% on the year with NVIDIA as its third largest holding, and Harbor Capital Appreciation up 15.46% this year. NVIDIA is its largest holding. So to say, for many of the growth funds or blended growth and income funds, this week with NVIDIA's earnings, it was a pretty important week. We'll get into NVIDIA's earnings in a few moments here in point number 2. But before we do, let's go through our normal roundup of economic data to try to get a feel for where the markets and the economy are at right now. First, each week we review the Atlanta Fed's GDP Now model. This model helps us gauge in real time if the economy is shrinking or growing, and if it's growing, as it normally is, by how much. This week, the number has come in at an impressive 3.5% after 2 reports from the U.S. Census Bureau and the National Association of Realtors this last week. This is impressively over the 2% number we saw much of the 2010 decade. And now let's check in on the 15 and 30-year mortgage rates to gauge if we will see home affordability improve and thus unfreeze the housing market and improve our economy even further. This week, the 15-year mortgage dove down to 6.24%, and the 30-year mortgage dropped to 6.94%. Very nice movements after inflation readings for April showed that inflation is starting to fall again. How about the initial claims for unemployment insurance or the front end of the labor market, as we call it, which is to say those leaving the labor market as an employed worker and becoming unemployed for the very first time in this recent go-round. This number came in at 215,000. Which was a drop from the previous week where we saw a small uptick. And finally, the markets this week. The S&P 500, which is our proxy for growth and income, but only when taken together, that was positive to the plus side, 0.03 this week, barely inching out a gain, thanks to the earnings report of NVIDIA. Unfortunately, the 2 other indexes did not have NVIDIA in them, so the Russell 2000, which tracks small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, that was negative 1.27% this week. And the MSCI EFA, which tracks all the stock markets of the developed nations, excluding the U.S., was negative 0.72% this week. Point number 2. In the latest quarter, NVIDIA's revenue more than tripled from the previous year, reaching $26 billion. Net profit surged over sevenfold to $14.88 billion, setting new quarterly records and exceeding analyst expectations. Now, their CFO, Colette Kress, revealed that large cloud computing companies such as Google, parent company Alphabet, Microsoft, and Amazon accounted for approximately 45% of NVIDIA's data center revenue, which, as you can see on your screen, is the largest segment of their revenue and where all the growth is happening, total over $10 billion. Over the past 12 months, NVIDIA's stock price has more than tripled, elevating its market valuation to above $2 trillion, as we just talked about. And following the earnings report, the stock was higher 6% in trading, and they surpassed $1,000 a share. Now, they are going to do a 10-for-1 stock split, which is going to be effective June 7th. And they also announced that they're going to increase their dividend 10 cents a share from 4 cents based on the current share count. That's going to go down to a penny a share when they do their stock split. NVIDIA's sales momentum sharply increased about a year ago, if you remember, and that was all around OpenAI's ChatGPT, where they impressed users with its human-like text generation capabilities. Now, analysts attribute this achievement to thousands of NVIDIA's AI chips, which are critical for the computational demands of creating and deploying such systems. With limited alternatives available, big tech companies and AI startups have been in a race to secure as many of NVIDIA's chips as possible, resulting in a shortage expected to last through this year and into next. But they're getting them in a few weeks as opposed to years later, like was the case last year, months later. While NVIDIA's growth rates are expected to de-accelerate due to tougher year-over-year comparisons, the company's outlook of about $28 billion in sales for the current fiscal quarter still surpasses expectations, nearly doubling the sales level from the same quarter 1 year prior. And one thing that's probably going to help NVIDIA continue its momentum is going to be a new $30,000 chip. And the code name for that chip is called Blackwell. That was announced earlier this March at their company conference. And according to NVIDIA's CEO, these chips are going to bring in a lot of revenue. And there has been little pause in buying their current chips because everyone is anxious to get their infrastructure online, considering that they're making money from it. So even Blackwell is not stopping the demand for current chips. NVIDIA, amazing quarter. Point number 3, after seeing the first quarter increase in inflation, where we saw core PCE go to 3.7 versus 2.0 for the fourth quarter of last year, Federal Reserve officials decided in their May meeting to keep interest rates higher for a longer period. According to the notes from the meeting, many FOMC members have questioned if current policies were restrictive enough to lower inflation to its 2% target. The inflation rate was reported last week, and it was 3.36%, with core CPI coming in at a month-over-month 0.29. Officials generally consider their policy that they're at currently restrictive, but some believe higher interest rates may not affect the economy as much as they have in the past, meaning the neutral rate, the rate which demand is neither slowed nor stimulated, could be higher than we previously thought. Minutes from the last meeting showed that many participants commented about their uncertainty about the degree of restrictiveness of interest rates. While April's consumer price data showed that inflation is cooling after 3 months of higher than desired readings, which is what took the market down in April, Fed Governor Christopher Waller stated that he would like to see several more months of positive inflation reports, meaning it going down, before he would consider lowering rates. Although the economy is growing at a solid pace, recent reports suggest that demand is easing a bit, while the labor market, though resilient, is showing signs of cooling, although again, good to see those initial claims coming back down. Future markets indicate that investors are anticipating 1 to 2 more rate cuts this year, and data from the FedWatch CME group is predicting the first of these cuts is going to happen in September 2024 at the meeting then. At their most recent meeting, Fed officials voted to reduce the cap on runoff of treasuries to about $25 billion. That was actually $60 billion. Most participants supported the new cap, though a few officials supported maintaining the current pace of runoff or enacting a higher cap on treasuries. And finally, point number 4, the bond market is signaling rougher economic conditions as investors are being paid more to hold shorter term debt than to hold longer term debt. Better rates for shorter term than longer term. This occurrence is referred to as an inverted yield curve, and it has persisted for the longest period in U.S. history. The short end of the yield curve is heavily influenced by the Federal Reserve's monetary policies, what we just talked about, their Fed meetings where they change rates, specifically the short-term Fed funds rate, as discussed in point number 3. Recent commentary from the Fed suggests that interest rates will remain higher for longer to combat inflation. Again, those bad readings January through March. This has pushed the yield on the 2-year Treasury notes close to 5%, and conversely, the long end of the curve, more tied to economic growth, appears to be reacting to a potential slowdown, hence why it's a little bit lower than the short end. Investors may be purchasing longer term debt to secure higher yields, anticipating that an economic slowdown would lead to interest rate cuts, meaning I'm not going to get this higher rate that I'm getting today in a few years. While we have been seeing short-term interest rates rising lately, the yield on longer dated debt, 30-year, 10-year, has been lagging, exacerbating the yield curve inversion. In such a scenario, locking in the current relatively high yields on longer-term bonds or other fixed investments might be attractive to investors. We've certainly been talking to clients about that lately. The Federal Reserve's decision to reduce its balance sheet, specifically their bond portfolio, which is what we just talked about, allowing $25 billion to mature monthly without reinvesting it, is also influencing the yield curve. This action increases the money flowing into the Treasury market, potentially driving up prices and lowering yields, particularly on longer dated securities, thus contributing to the persisted inverted yield curve. Again, inverted yield curve, shorter term rates better than longer term rates. Something we typically don't see other than when there's recessions, although, again, we've been in the longest inverted yield curve ever. So at this point, we would say maybe it's telling us something different. Maybe something different than what it typically tells us, which is economic contraction is getting ready to come. Maybe it's just telling us that, hey, right now, because of higher than normal inflation, we just have shorter term rates. We'll just have to see. Something we'll continue to watch. So thanks so much for watching this week's video. If this week's video was helpful to you, could you do us a favor? You can do us a favor by hitting the like and the subscribe button. The like button helps us with YouTube, Google, and Rumble's algorithms, and the subscribe button allows our content to be pushed out to you as we release it. As well as if you'd like to meet with any of our financial advisors or coaches, you can go to the comment section of this video. In the comment section, you can click a link where you'll be able to schedule with our coaches who help you in baby steps 1, 2, and 3, get out of debt, stay out of debt, and live on a budget. And our planners who will help you in baby steps 4, 5, 6, and 7, build that retirement plan, save for kids' college, and work out a plan to pay off your mortgage. So thanks so much for watching this week's video. We'll look forward to seeing you next week.